Masimo just pulled off a move most stocks never make. A 34% explosion in a single day. No earnings, no hype, no product launch, just one headline that instantly changed the price of the company. A cash buyout. And here's the twist that confused a lot of retail traders. Masimo went vertical while the company buying them dropped. If you don't understand why that happens, you're going to misread takeover trades. Let's rewind. Friday, Masimo closes around 130. Quiet healthcare stock, barely on retail radar. Then overnight, the deal hits. Danaher says, we'll buy the entire company for $180 per share in cash, not stock, not subject to market, cash. Now pay attention to this. When a real cash offer drops, the stock doesn't slowly climb. It teleports near the offer price. That's why Masimo didn't grind up. It gapped straight into the 170 range. This wasn't momentum. This was math. 130 stock, 180 buyout, 40% premium overnight. Wall Street immediately repriced the company to the deal value. And that's where most retail traders get it wrong. They see a huge green candle and think breakout. They chase it like a growth move. But this stock is no longer trading on earnings, products, or guidance. It's trading on one thing only: deal probability. Here's the question that creates the confusion. If the buyout price is 180, why isn't the stock at 180 right now? Because the market is pricing risk. The deal still needs shareholder approval. Regulators need to sign off. The timeline runs into the second half of 2026. And there's always a small chance the deal breaks. That gap between the current price and the 180 offer, that's the merger spread. That's where hedge funds step in. They buy below the deal price and collect the difference if the deal closes. This surprised Wall Street because retail traders usually ignore merger arbitrage completely. Quick reset. Masimo up because of the buyout. Danaher down because buyers usually drop. Stock now trades like a contract, not a company. Now let's talk about the part most people missed. Masimo didn't randomly get bought. It was under activist pressure for years. Board fights, strategy battles, investors pushing for change. Activists don't show up for fun. They show up when they think a sale is coming. That was the early signal. By the time the headline hit, the real money had already positioned. So why did Danaher want Masimo so badly? Because this isn't just a purchase, it's a platform move. Danaher is building a diagnostics empire. Masimo brings hospital monitoring tech, non-invasive sensors, and AI-driven patient data. That plugs directly into Danaher's healthcare machine. Long-term, that's growth and cross-selling. Short-term, it's debt, integration risk, and a big price tag. That's why Danaher's stock dropped. Classic buyer down, seller up. Here's the retail trap. If you buy Masimo now expecting another 30% rally, you're too late. The upside is mostly capped near 180. The only way this stock runs higher is if another bidder appears with a higher offer. Rare, but that's the wild card. And remember the timeline. This deal isn't closing next week. It could take months, so your capital sits there for a small spread. That's not a swing trade. That's merger arbitrage. Different strategy, different risk, different patience. Let's talk about who actually wins. Original shareholders, massive payday. Activist investors, mission accomplished. Hedge funds, collecting the spread. Late retail buyers, limited upside. Full deal risk. Here's what could happen next. If regulators move smoothly, the stock slowly drifts toward 180 and stays there until closing. If there's a delay, the spread widens and the stock dips. If the deal breaks, the stock can fall hard back toward pre-deal levels. If a new bidder appears, the stock spikes again. Those are the only four paths from here. Now zoom out, because this is the real opportunity. This deal tells us something bigger. Healthcare diagnostics is consolidating. Large players are buying niche tech companies with data, monitoring, and AI capabilities. That means there are more takeover targets hiding in this sector. And that's where the real money is made. Not chasing the company that already got bought, but spotting the one that might be next. Look for activist involvement, strategic reviews, undervalued niche tech, companies that fit perfectly into a larger platform. That's the playbook. Final thought. This wasn't a hype rally. This was Wall Street repricing a company overnight because of a cash deal. Masimo now trades on deal odds, not business performance. Danaher is making a long-term strategic bet, and the real edge for retail investors is learning to spot takeover setups early. So, here's my question for you. Would you park your money in a merger spread for months for a small calculated return, or are you hunting for the next buyout target before the headline drops? Tell me in the comments.